Compounding. Last week, we dove into what compounding is, why it's so important, and then we discussed how compounding could potentially change your investing future if you understand it. Today, in this second part of this series, we're going to be talking about the nuances surrounding compounding. We'll unpack how compounding actually works, and then discuss some live examples so you can really conceptualize compound interest. There are a range of different questions that flowed out of last week's initial discussion. But I think what's first and foremost most important to understand is that compounding is not by itself a strategy. It's a mechanic or a process. Of course, there are a range of different strategies that can center around a compounding focused strategy. You might have heard of the dividend reinvesting compounding strategy, for example. But compounding itself is a mechanic, and also it's a mindset and an approach that you take to markets. So to really help to conceptualize and understand that, let's think about two ends of the spectrum. On one end, you might have your most speculative asset types. Potentially it's your altcoins or your cryptocurrencies. Those can still be compounded. Of course, the risk is far greater on that side than, say, the other end of the spectrum, which might be a savings account or a term deposit. Of course, the rate of compounding there would be much lower if it's 0.5, 1%, or 2% in a savings account. However, that in itself can still compound. It will just take longer to achieve the goals. However, of course, anything that comes between those two ends of the spectrum could conceivably be compounded, but there are a range of different components that make up that rate of compounding and the risk-reward trade-off that investors are often perceiving. But we'll be discussing more of that later on in the video. Before we get into that, it makes sense for us to take a step back and have a think about what is compounding itself. So compounding is the process where accumulated interest is added to the original principal amount and reinvested. Compounding is often referred to as interest on interest. As I'm sure you're all familiar with, compounding, the returns, the gains, have the ability to grow exponentially, particularly with the returns being more pronounced over longer term periods of time. Einstein once famously said that compound interest is the eighth wonder of the world. But with all of that context, with all of that understanding, you might be wondering, how does it actually work? So there's three core components to the compounding equation. You have your deposit. This is the initial principal that goes in, and then oftentimes you can have additional capital that's added, whether it's dollar cost averaged or whether it's added on individual milestones. Then you have the rate of growth, which is expressed as a percentage. And then time. Time often for the purposes of modeling and forecasting is done on an annual basis, but of course compounding can happen far more frequently, potentially daily, weekly, monthly, or on a longer time basis as well. But these are the three components that are worth understanding, or you can view them as the different levers that you can pull: the deposit or the capital, rate, and time. However, like anything, like life, like valuations, anything in life is merely a matter of inputs coming together, meshing together, and then providing us with an output. To help to visualize this, think about cooking. It's something that we all do. Of course, we have our own individual recipes. You'll go to cook, you have your different ingredients that come together. Maybe you might be like, I need a little bit more salt. Not enough sauce here. Let's add a little bit of pepper. And hopefully if things come together nicely, those inputs, which are your ingredients, come together and provide you with the output, which is hopefully a nicely home-cooked meal. On the other side, if you want to think more financially, valuations, it's as simple as a number of inputs, which we view as assumptions, because of course nobody knows exactly where the future will head, but the inputs are our assumptions, and they come in and provide us with our output, which is often a valuation, but there's a range of different things that we can look to. The inputs can include factors such as your growth rates, the total addressable market and forecasted growth in that level, margins, the discount rate used, and so on and so forth. What's worth noting, however, is that nobody knows where the future will head. Models forecast their insights about potential trajectories and insights about where we think things may head, but of course, they're heavily reliant on our assumptions. And at the end of the day, there's this famous quote that you might have heard that says, all models are wrong. Some models are useful. Now, this discussion surrounding compounding is not to say it's right or wrong or what can be achieved. Of course, I'm not a financial advisor. As you guys know, nothing we discuss is financial advice. It's just a general discussion that's hopefully an interesting starting spot for you to do your own research from. But compounding is an interesting mechanic that's worth noting, particularly for those who are more longer term minded and more longer term inclined when viewing how they engage with the markets. And so with that, it makes sense for us to have a look at some different examples of how compounding works in practice. And so as we dive into some examples using the compound interest calculator, I thought it made sense for us to start initially using the basis of an example that we discussed in last week's Mindset Monday episode, surrounding the $10,000 over a 3-year period. Now, firstly, thinking about it from a simple interest type of mindset. As we understand with simple interest, it's interest accrued. However, the interest that's accrued over a time period is taken out. It's not reinvested. And so as a result of that, if we think about $10,000 using simple interest over 3 years, in the first year, you'll receive $1,000, which is 10%. The second year, $1,000. And the third year, 10% is $1,000 again. So with $10,000 over a 3-year period of time, that will then end up being $13,000. However, if you think about it from a compound interest type of mindset, you will see that in each year, the $1,000 initially is not taken out, but it's reinvested. And you'll see how compound interest works here. So in that first year, you can see here, you get 10% of $10,000. That's $11,000. It's the same as a simple interest type of mechanic. But in the second year is where it starts to get interesting. Here you see in the second year, that $11,000 you get 10% of. So you're not getting 10% of the $10,000. It's the $11,000, which has been added to it, which ends up being $1,100. And in that second year, instead of $12,000, you've got $12,100. Then in the third year, rather than taking that money out, you're then getting 10% of $12,100, which ends up being $1,210. And so that's then added to the interest. And this is where the compounding kicks in. And total, you have $13,310. So you might be thinking, okay, that's great. You've got $310 extra. Maybe it's a bit more petrol money and you can pay off a couple of bills. But is it really moving the dial? However, as we mentioned earlier, there's 3 different components or ingredients that we can put into compounding. As we mentioned, you've got your deposit or your capital. You have your rate of growth, which is expressed as a percentage here. As we can see here, that's the rate of capital and then potentially deposits. And then the third one, of course, is time. And time is the one that really blows a lot of people's minds when they see how it can be so pronounced, especially over the longer time periods. So as we can see here, we're adding about $1,000 per year initially. Of course, that's growing a little bit. Let's see how it tracks over time. So we had 13,310. Let's say over the 5th year, you'd assume it's probably going to be around about $15,000 over that 5 years. But we see it actually goes to $16,000. Hold on, we're starting to pick up a bit of pace now. It's no longer just $1,000 a year. Let's see what happens in year 7. Is it $17,000, maybe $17,500? There we go. It goes to $19,000. So let's see what happens in the 10th year. Does it go to maybe, you might assume, $20,000, around about $10,000 for $1,000 a year. But this is where over long periods of time, you start to see compounding really pick up. So here you can see it goes to $25,000. And obviously over longer term periods of time, you can see here with the numbers, the initial deposit stays constant, $10,000. No regular deposits for this example here, but the total interest you can see that's being added. So in this second year here, you're adding over $2,000 of interest. So $13,579 to $15,937, about $2,400 in 1 year. And then over longer term periods of time, $12,000. You can see here, it's really starting to pick up pace now. This is that same initial deposit of $10,000 over 15 years. You can see here, the rate of compounding starts to get that exponential growth over longer term periods of time. And that picks up more and more and more. And so as you can see here, of course, over that long period of time, 20,000. So in that 20th year, if you see this initial $10,000, so you've got $57,000 of total interest paid, giving you a total of $67,275. Now have a look at that last year. So if you go to 21 years, it was $67,000. In that last year, you're adding over $6,000 to $7,000 just in 1 year from the interest. And that's the magic of compounding, that it adds up and it accrues and accumulates over long periods. You remember that simple interest discussion. If you're in that 21st year, you would still only be adding $1,000. Now, of course, this is assuming a constant rate of growth of 10%. If you're wondering what's a fair rate of growth, obviously everybody's going to have different financial goals and aims. But when people try to model out, they say that on average, the market moves around 8 to 10% a year on year. Of course, some years it's going to go higher, other years it's going to go lower. And so when people are trying to conservatively model, often a 7% figure is used to give an insight into what you could, if you're looking to match the market over long periods of time. But what becomes really interesting here is you can see the difference. Imagine over 10 years, 7% interest rate. So you can see here, it goes to $19,672. And if you want to get an insight into the differences that interest rates make, you can go to 10% there. As we discussed, that was at $25,000. But if you can get an extra 2% year on year, and that's not easy over longer term periods of time, you can see the rate of growth that suddenly it starts changing. But what becomes really, really fascinating here is if we assume this consistent, say 7% is that conservative market matching figure over longer term periods of time. Initially, so if you're starting with $10,000, Potentially, rather than just having a $0 regular deposit, maybe you can dollar cost average in $5,000 each year as well. If you're able to attain a 7% year on year over long periods of time, that initial $10,000 can grow to $88,000. And so then over longer term periods of time, depending on your age and how long you want to model out, if you have a look at 20 years, if you've just got that initial deposit of $10,000, $5,000 year on year, adding 7%, you can see that it starts to add up pretty quickly. And this is where they talk about compounding being an enabler of long-term wealth accumulation. It's about consistency, of course, and it's about the ability to set a goal and to stay focused at it over long-term periods of time. But as you see, when you start to play around with a compounding calculator and you change some of the parameters around, you can get an idea about what you need to do to achieve your financial goals. And as mentioned, they're going to be different for each individual person. This is just using a templated basic generic discussion here, so it can't be applied to your own discussions, but hopefully it's a fascinating starting spot, and I'd be very keen to hear your thoughts on it all as we unpack it further. And so I hope that was an interesting thought exercise for you. You can find compounding calculators on the internet if you want to have a play around with them, and I encourage you to spend some time getting familiar with the parameters and how things can look. Of course, you can build your own in Excel as well if you want a bit more maneuverability. But that leads us to what are some of the insights that we can take away when we're thinking about our own strategies or the way that we engage with the market. I think there's 3 core takeaways here. First and foremost, the most intuitive one is that we should be trying to develop our own strategies. We don't want to be approaching the market or anything that we do in life with individual efforts and just as one-off discrete engagements. We want to develop a strategy to be proactive, to think long-term, and also to think about how do we want to engage with the market. It's going to be different for each individual person. Everyone's circumstances are different. Everyone's goals are different. And of course, we've got different parameters, whether it's the types of sectors that we like to look into. What's our risk tolerance? How much time do we want to spend on the market? Do we want to spend 30 minutes and have quite a hands-off, risk-averse approach to the market? Or do we want to be more in tune with spending each and every day 3-4 hours? Do we enjoy the analysis? That's going to feed into the types of strategies that we develop. And then ultimately, what are the goals that we want to achieve? On that second front, I do think it's important that we think within a strategy. I think a lot of people just think, oh, the stock market's like a casino. Just need to pick that one lucky stock, got to hit that home run and everything will be fine. That's not how it works. We need to think within a strategy. We need to develop a long-term focused mindset on this and need to understand that, hopefully the stock goes green or higher is not a strategy in itself. Of course, if you develop and implement a successful strategy, that will be a byproduct and hopefully the result of a strategy is those things will happen. But we need to think about everything that we do within a portfolio and within a broader decision matrix rather than just on an individual basis. And then thirdly as well, but it takes time. I think often we can get caught up on the day-to-day, the granular, and it's not to say that these are not important factors to consider. And of course, we want to see how things are tracking day in and day out. But if we're thinking about things on a longer-term mindset, it makes sense at times to zoom out, to think about things on a longer-term horizon. Of course, this is not just to say that we can close our eyes, blindly leave things in and hope for the best, but however, we know that over long periods of time, the markets move up. And of course, this is not to say that past performance is going to be any indicator of future success. But often we can look towards history to give us an indication about how the future potentially might look. There's that famous quote that's thrown around that the stock market is a device for transferring wealth from the impatient to the patient. I'm sure that many of you have heard it. And of course, none of us know how the future's going to look. But often with compounding, sometimes we just need to be patient. We just need to give it enough time. If you didn't see our video last week on compounding, here's a link to it that you can check out after this one. I'd love to know your thoughts. Drop in a comment below what you think about compounding. And I hope you enjoyed this in our next iteration of the Mindset Monday series. Big thank you for joining us. For now, stay well and happy investing.